Welcome back to another episode. This has been a busy week. A ton of news came out that we're going to cover in this video. But before we get started on that, I want to talk about how I'm planning on changing my videos a little bit. So these episodes, I want to do them every Saturday, pretty much, going over the portfolio, continuing to provide full transparency and insight into all my buys and my sales and what I'm thinking. I want to talk about any major or like macro level news that come out during the week and are important to the market. Any policy changes, Fed inflation reports, that's something that came up this week, and pretty much anything that we as investors should be keeping an eye on, especially if we're invested in individual stocks. I also want to cover any news surrounding the companies I own or companies that I want to own. And when we're not in the middle of earnings season and things are a little bit calmer, I want to include more segments on my investing philosophy and what I'm learning, and maybe include some segments on the investors that I chose to study. So if you're someone who doesn't quite have the time to stay up to date with the market every single week and want someone to summarize the information for you every single week, you should consider subscribing and watching these videos when I post them on Saturdays. So with that out of the way, let's jump in. First, we'll start with looking over the portfolio. It's been a pretty rough week. We're down 6%, but there are a couple reasons for that, which we'll cover in this video. Then we'll look at this report that was released that the Trump team seeks to toughen chip controls over China, which is affecting companies like Nvidia, AMD, and ASML. And obviously, I own AMD and ASML, so this is important news. Then we'll move on to probably the biggest news of the week, which was Nvidia's earnings on Wednesday. Then we got news that Jeffries upgraded Nike, a company that I own, and raised their price target on the company. So I'm interested in hearing what they have to say. On Tuesday, PayPal hosted their Investor Day, which allowed me to see the company as more than just a turnaround play. We'll take a look at what was said during the Investor Day and what they have planned for the future. We also have the word stagflation being thrown around, so I'll explain what that is and why it's making investors so worried about the future. And lastly, yesterday on Friday, the PCE report was released, the Personal Consumption Expenditures Price Index, which is what the Federal Reserve uses to measure inflation. We'll take a look at the report, see what it says, and what this means for stocks moving forward. So we have lots to cover. Let's jump right in. First up, we have this report that the Trump team seeks to toughen chip controls over China. The report states that the Trump administration is planning to toughen semiconductor restrictions on China, continuing and expanding the Biden administration's efforts to limit Beijing's technological prowess. Some Trump officials also aim to further restrict the quantity and types of Nvidia chips that can be exported to China without a license, the report said. And that has been a worry for stocks, especially if you own stocks that are exposed to China in this way, which is AMD and ASML, and obviously Nvidia too, but I don't currently hold Nvidia. So we need to understand how exposed to China these companies are. And this article from July 2024 says that Marvell has the most exposure to China, 45% of total revenues, followed by ASML, Nvidia, and AMD, generating roughly 41%, 20%, and 15% of revenues, respectively. So, out of these companies, AMD has the lowest exposure to China, which is good for me since it's my biggest position. However, for ASML, coming in at 41% of their total revenues, that number is slightly high because during the last couple of years, as the demand for semiconductor declined, ASML has been fulfilling more orders from China from the backlog, and they expect that to normalize again in 2025 as demand picks back up. But this shouldn't come as a surprise to investors. We've known about these risks with China for years now, and that's why we've seen chip foundries being built in the US and why different countries have started buying and building chip manufacturing equipment outside of China. But I see this as a short term issue. The demand for semiconductors isn't going away anytime soon, and AMD and ASML will simply start fulfilling more orders outside of China if this ends up going through. I continue to buy AMD every single week and for the past couple weeks. And now that ASML is also taking a hit on these news, I will likely start buying more ASML shares as well. Both companies are extremely attractively valued right now. Next up, we have Nvidia Earnings, which came out on Wednesday, where the CEO said that AI has to do 100 times more computation now than when ChatGPT was released. Overall, the earnings report was good and better than investors expected. For EPS, 85 cents were expected, but they reported 89, beating by 5.25%. For revenue, 38.1 billion was expected, but they reported 39.3, beating by 3.13%. However, it seems like these results weren't quite good enough for Nvidia investors who have come to expect a lot. So anything other than mind-blowing just didn't do it for investors. What more can you ask for than a 78% increase in sales year over year and a 93% jump in data center revenue? Forward-looking guidance was also very strong. Or maybe the market is simply worried about the uncertainty surrounding tariffs, chip controls, and inflation. Let me know what you think in the comments below. But going back to the article here, Nvidia CEO Jensen Huang said next generation AI will need 100 times more compute than older models as a result of new reasoning approaches that think about how to best answer questions step by step. The amount of computation necessary to do that reasoning process is 100 times more than what we used to do, the CEO said in an interview on Wednesday following the earnings report. So that's obviously great for someone like me to hear who holds a ton of AMD and ASML. If the demand for chip just continues to rise, as the Nvidia CEO suggests, that just means more revenue for AMD and ASML. And I've said it before, people think it's a winner-take-all market between AMD and Nvidia, but it simply isn't. There's enough to go around for both companies. And obviously my reason for picking AMD is the lower valuation and the longer runway of growth. Next we have the news that Jeffries raises Nike, says there are changes afoot for its new top pick. In this article, they say that the new CEO, Hill, is tackling product and distribution issues head on, positioning the brand to again outgrow the market and take back lost share. Despite recent struggles, Jeffries sees a strong path forward for Nike. Survey work illustrates Nike's brand remains very strong, proving that issues were self-inflicted and the competitive threats less severe. They project a V-shaped margin and EPS recovery in fiscal 2027, with earnings estimates at $3.50 per share, well ahead of the consensus estimates of $2.95 a share. Nike is a company that I've been buying for quite some time now. I started buying the company here in January 2024, around $100 a share. These were small buys at the time, but as it continued to drop, I bought more around $90 and I bought more in the 70s. And currently my average cost is $84. And I'm down just under 6% on the position. So it's good to finally see that investors are realizing that it's not necessarily an issue with the Nike brand, but rather mismanagement of the company. If we look at more recent price action, it's clear that the company has bounced back a little bit. Since the lows here of $68 a share, the company has recovered around 15%, I want to say. It'll be interesting to see how far the company can run this year, but I see this as a long-term pick, so I'll be holding this company for years to come. Moving on to PayPal's Investor Day on Tuesday. As I said, this event allowed me to see the company as more than just a turnaround play, a company that I might hold on to for longer, as they could return to decent growth if their vision ends up playing out. They plan on using their data and their huge network of 223 million monthly active users to personalize commerce both online and offline. And to best explain this innovation and this vision that they're talking about, I'm going to play a short clip from the event of the CEO talking about this.
I should be able to go to a website and actually have it personalized for me. We should be able to leverage a commerce API that PayPal can provide to actually let the merchant know that I'm on a camping journey. On top of that, we should be able to do things like create a consumer profile. We already have over 80 million profiles of consumers that start to share information like the journeys that they're on, the items that they're interested in, their favorite colors, their shoe size. So now the merchant can actually create the exact customized, personalized shopping adventure for them. I now get to see the boots that I need. I get to see the color that I'm interested in. I get to see that it's in my size. And I already know that I have PayPal loaded up and ready to go, so I can create a buy now experience right now. On top of that, when I actually get to check out, they know that I'm an Amazon Prime member. So they can offer free shipping and just reducing any friction to the purchase experience. This is an incredible personalized experience that by the time I get to the end, I have now an end-to-end experience and loyalty already built in with this merchant. This is a very different experience than what exists today. We think we can engage with merchants and let them again know who you are from a personalized experience and let them know that this is an opportunity to provide a discount, to provide some loyalty, to leverage the ability for me to be in the right environment of this sporting goods store and say, hey, you're right here right now. Why don't you come into the store? We know that you're on a camping journey. Let me give you a discount because you're a new customer to us, and the cost per acquisition that I would have paid to try to get you, I would rather just put in your pocket to have you check out with us right now. On top of that, I can actually have that loyalty. It's almost impossible for me to get a loyalty card into your wallet. Why not have it just show up into your PayPal wallet? It's activated, it's available, and it's automatic when you check out.
If they manage to execute on this, customers will have a better experience, which leads to more sales and lower acquisition costs for the merchants. What merchant would not want that? And as more merchants start processing payments with PayPal, that's just more service and transaction fees for PayPal. So as I said, this event allowed me to see the company as more than just a turnaround play. I was buying the company back here at the end of 2023 when the valuation was ridiculously low. And since then, at one point, I was up 50% on the position. But it's come down a little bit since then. The valuation is currently at a 14 forward PE, so it's still ridiculously low. And if I didn't already have, a massive 10% position in the company, I would probably be using this dip to get in. In their presentation, they showed this transaction margin dollar expected growth. And for the 2025 guidance, they see at least 5% growth. By 2027, they see high single-digit growth. And in the long term, they see that growth going above 10%. So that's what I'm saying. If they can execute on this vision and bring their company back up to relatively good growth, I could see this as more of a longer-term hold and a company that I would hold for years to come, because it would then meet my growth expectations for a company that I hold in my portfolio for years and years. Moving on, we have fears of stagflation returning. And to explain what stagflation is an economic cycle characterized by slow growth and a high unemployment rate, accompanied by inflation. Economic policymakers find this combination particularly difficult to handle, as attempting to correct one of the factors can exacerbate another. In other words, prices remain high while unemployment continues to rise. And this is an unusual situation because inflation usually comes with a strong economy. And if the economy slows down but prices don't, it makes things harder for businesses and consumers. This situation can hurt stock markets since companies struggle with higher costs and lower consumer spending. And this brings us to the last news of the week, the PCE report. This report, the Personal Consumption Expenditures Report, is the Federal Reserve's preferred inflation measure. And each time it is released, CNBC does this segment going over the numbers that I like to watch. So let's watch it together.
Rick Santelli is standing by at the CME in Chicago, and he has the number of the day and week. Sir.
Yes, these are definitely the numbers of the day and week, and they're populating slowly. Let's go in reverse order. Oh, they're on the wires now. Personal income, more than double expectations, up powerfully strong, up 0.9%, almost up 1 full percent. And this is the highest read going back to January of last year. So a one-year high on the income side. On the spending side, a completely different story. We're expecting a number up a couple of tenths. Well, it's down a couple of tenths, down 0.2. That's the weakest spending number going back to, and I'm going to have to go back to February of 21. February of 21, we had the minus 0.1. That was March of 23. So these numbers have been mostly small to the upside. This is a big drop. Now, if we look at real spending adjusted for inflation, it gets worse. Down 0.5%. That'd be the weakest level also since Feb of 21. Now the meat on the bone here, PCE index, the headline number month over month, up 0.3 as expected. And do keep in mind, even though it was as expected, to find a higher number, you're going all the way back to January of 24, which was up 0.4. Now, if you look at the PCE year over year, it's up 2.5. It's up 2.5 as expected, 0.1 cooler in the rearview mirror. 2.5 would be the smallest number since it was 2.4 in November. Do remember last month's 2.6, which still stands unrevised, was the highest since April of 24. Now let's go back to month over month and switch categories to the core numbers. Core PCE month over month up 0.3 as expected, 1/10 hotter in the rearview mirror. To find a hotter number, you're going back to, depending on how you round, 0.34 in March of last year, or 0.5, which was January of last year. And finally, maybe the most important number of all, 2.6 on the year-over-year core PCE. That's as expected, and the rear view mirror was updated from 2.8 to 2.9, which would make last month's 2.9 the highest since March of 24. It reverses to 2.6. 2.6, well, to find a smaller number, you're going all the way back to March of 21 when it was 2.2. So we can argue here that the numbers are basically a bit better than expected or as expected on inflation. The spending numbers, both real and unadjusted for inflation, are a bit scary here. Now, real quickly, let's take some other things out of the way here. On the trade balance, the January final read, well, it goes to minus 153 billion. This is just downright incredibly large. The biggest pre-COVID deficit we had was minus 78 billion. The data goes all the way back to 1989. There's nothing higher than minus 153. Last month's minus 122 was also an all-time high. So these trade balances, the amount of money that's in this country is really large, and we could debate whether it's a good thing or a bad thing. We know the president doesn't like it. Retail inventories drop again. This is another oddity here. Down 1/10. Last month was down 0.3. It's now down 0.5. You have to go way back to find back-to-back negative numbers on this. You're going back to 2021. Now, if we look at the wholesale inventories, an exactly opposite picture, up 0.7. That's a powerful number. To find a higher number, you're going back to August of 22. So retail's going down, wholesale's going up. Interest rates right now are moving higher on these data points. If you look at what the low yield has been intraday on all of these moves in tens, it's basically about 421, 422. Right now we're hovering at 427. Last week we settled at 443 to show you how much we have dropped.
So in the past 2 months, we saw this reacceleration of inflation, as in inflation started ticking back upwards, and people were worried that inflation could be sticky or essentially hanging around. However, this month, the year-over-year PCE inflation number was 2.5%, which is down from last month at 2.6%. So this was a good report and provides just a little bit of relief of the beliefs that inflation was heating up again. But we still need to get down to the 2% target inflation rate. Now, looking forward, you've probably heard about the worries regarding Trump's tariffs, which might cause inflation in the short term, and Doge's impact on government spending and the layoffs that are happening, which could cause unemployment to rise, and from that, a slow in consumer spending. So there is a ton of uncertainty in the market, and I think the price action reflects that. If we look at the charts of some of the hottest stocks in the market, like Palantir, Hims, and Robinhood, you'll see that when uncertainty enters the market again, valuations start to matter again, and the drop can be extremely dramatic. Before this week, it seemed like no price was too high for these companies, and they reached absolutely ridiculous valuations because of hype and FOMO, in my opinion. Twitter was honestly an absolute shit show with the tweets that were being posted, like saying that Palantir could 100x from $125. I mean, what are we talking about? A $20 trillion valuation or something on Palantir? Well, anyway, look what happened. If we look at Palantir here, from the top in a week, 30% drop. Hims, same, in a week, 34% drop. Robinhood, almost a 24% drop. Now, if there's any of these stocks that I might look into and could be interested in, it's probably Robinhood. I've been interested in the company, so I might do some research on that one after this drop here. But as I said, there's a lot of uncertainty in the market right now, and it's causing a lot of volatility in prices. Personally, I don't pay too much attention to the macro level news, the inflation, the unemployment, and those things, because they're short-term issues and they'll be back the next year or the year after that, or maybe the year after that. I personally continue to buy. This week I bought more Uber at $74 a share roughly, and more Amazon all the way down at $206, which was a pretty good deal in my opinion. All right, that'll be it for this week. It's been a crazy week, and a lot of people have lost a lot of money. I think it's a good time to remind ourselves to think long term and continue to invest in companies that we believe in for the long term. I think these issues we're going through right now will be gone by next year, if not sooner. And here's a quick reminder that the S&P 500 has never lost over a 20-year period, as in it has never had a negative annualized return over a 20-year period. See you in the next one.